Mary Buffett, 7 Secrets to Investing Like Warren Buffett. Embark on a journey to master the art of investing like the legendary Warren Buffett with this book's summary. Guiding you through 7 secrets to investing like Warren Buffett, you'll learn effective strategies to save money, understand value investing, and leverage key insights to build long-lasting wealth. Delve into the minds of savvy investors and identify the characteristics that make a great investment opportunity. Beyond that, learn how to manage your investment portfolio wisely and watch your savings flourish. This summary outlines a step-by-step guide to help you emulate the investment prowess of the master himself, Warren Buffett.
Building wealth through habits. Generating wealth isn't just about investing, it's about creating good financial habits. Start by saving 10% of your income and gradually increase your commitment, making it a consistent practice. Aim to create a solid emergency fund, as well as securing an insurance policy for financial stability. Building wealth is about having the right habits, not just getting lucky. Picture investing like Warren Buffett. You might not expect a lesson on creating good habits, right? Yet, that's precisely the first secret to investing successfully. To invest money, you need money. So, before discussing stock picking, let's focus on setting aside funds to use for investments. Saving might not come naturally to everyone, but it's a fundamental secret to success, which is why it's essential to make it a habit, something practiced steadily and consistently. Start by saving 10% of your earnings. Transfer this money to a separate savings account, or keep it somewhere out of reach to avoid the temptation of dipping into your savings. Consistently add to this account with each paycheck. If 10% seems overwhelming, consider incremental savings. Save $1 this week, $2 the next, and so forth. Even though it might not seem like much initially, in a year's time, you'll save $52 a week. Starting small and gradually increasing your contribution is an effective way to establish a positive habit. It's all about keeping it manageable and consistent. Overambitious goals can be discouraging, especially when you stumble and fall, causing good habits to deteriorate. When you're steady and methodical with your savings, observe the growing pot of money. But how much should you aim to save? A good rule of thumb is to have a solid emergency fund, sufficient to cover your expenses for a while should your income vanish. Additionally, it's wise to invest in an insurance policy, such as an accident and disability plan. A policy covering 10 years of regular income is recommended. Spending money is easy, but the real challenge is saving and growing your money. Wealthy individuals have developed habits that keep them prosperous, which is crucial. Statistics show that people who win the lottery and become overnight millionaires often squander their fortune because they haven't built habits to maintain their wealth. By cultivating good financial habits, you'll set yourself up for long-term success and wealth generation. Mastering value investing. Imagine living in a world where you can buy $1 for a quarter, a lucrative scenario, right? Though we can't jump into alternate universes, this scenario reflects the core principle of value investing. Think of legendary value investors like Warren Buffett, who dedicates time and effort to determine the true value of a company and then compares it to its stock price. Learn from Benjamin Graham. Buffett's approach focuses on finding undervalued stocks or businesses worth more than their stocks sell for. This value discrepancy indicates a potential investment opportunity. Studies on value investing reveal that it is a strong strategy, outperforming speculation or gut feeling-driven investments. However, undervalued companies can sometimes become more undervalued after investment, leading to losses. Patience, as practiced by Buffett, plays a vital role in value investing, as the company's real value usually becomes recognized, leading to impressive returns on investments. Discover your circle of competence. To identify potential investments, start by determining your circle of competence, the realm where your interests, knowledge, and spending habits intersect. Warren Buffett employs this strategy, investing only in companies he understands well. Reflect on your experiences, favorite brands, and areas of expertise to pinpoint industries in which you have a competitive edge. The result becomes your starting point for identifying companies to invest in. Embarking on value investing requires knowing where to focus your attention, and the key ingredient is recognizing your circle of competence, the sweet spot where your interests, knowledge, and spending habits overlap. Legendary investor Warren Buffett is known for carefully choosing his investments based on a deep understanding of the businesses he invests in, like Coca-Cola, Kraft Foods, banks, airlines, and American Express. Instead of dabbling in unfamiliar industries, he sticks to what he knows best. You can determine your circle of competence by asking yourself a series of questions that delve into your experiences, preferences, and areas of expertise. Begin by reflecting on the types of businesses you've worked for, considering your industry and whether your company or its clients specialize in specific areas. Your unique career insights can give you an edge in identifying potential investments within these industries. Next, evaluate your spending habits by identifying your favorite brands, stores, or companies on which you regularly spend money. Checking bank statements can give you valuable clues. These are businesses you have first-hand knowledge of, based on your experience as a consumer. Finally, take a moment to acknowledge your expertise and hobbies. Whether it's cooking, rock climbing, or computer programming, consider how your strengths and passions could translate into investment insights. Once you've examined these three aspects, merge them into a kind of Venn diagram that addresses these questions. What do I love to do? What am I good at? What do I spend money on? This exercise will help you identify industries or business categories that lie within your circle of competence, and ultimately, guide you to the right investment opportunities. Uncovering economic moats. The fourth secret to investing like Warren Buffett is recognizing economic moats. An economic moat represents a buffer against potential losses, which companies with long-lasting and resilient products or services provide. Examples include Coca-Cola, Pampers, Nike, McDonald's, and Burger King. Another indicator of an economic moat is the existence of economies of scale, as seen in Amazon's low-price model. However, it is important to note that economic moats are not always permanent, especially in industries heavily dependent on innovation, such as technology. Ever wondered what makes some companies more resilient and stand the test of time? Warren Buffett's secret to successful investing involves identifying such entities, which he terms as having an economic moat. Companies with an economic moat offer products or services that can withstand fluctuating market trends, economic downturns, and shifting consumer preferences. Think of Coca-Cola, a brand that has survived depressions and world wars, still appealing to multiple generations. Pampers is another example, with its name often being synonymous with the product itself. Another key aspect of an economic moat is the ability to maintain a higher price point while still winning over customers, like Nike, McDonald's, and Burger King. Such companies are likely to stay dominant for a considerable period. Another sign of an economic moat is the presence of economies of scale. It typically means a company has an efficient, low-cost production model, allowing it to offer more competitive prices. Amazon epitomizes this concept with its unbeatable prices, often making competition irrelevant. However, it is crucial to recognize that economic moats may not be eternal, particularly in technology-driven industries that rely heavily on innovation. For example, the iPhone might seem to have a solid economic moat, but its success hinges on Apple continually staying ahead of the competition. A disruptive and innovative product in the future could render the iPhone obsolete. In conclusion, be on the lookout for economic moats when investing, as they indicate resilient companies with products or services that endure market fluctuations and time. But remember, not all moats are everlasting, so be cautious about the industries you choose to invest in. Unveiling Buffett's investment secrets. The fifth principle of investing like Warren Buffett is understanding the language of business by learning to read financial statements, specifically, the balance sheet, income statement, and cash flow statement. Assess a company's debt-to-equity ratio and net worth through the balance sheet, net profit and return on equity within the income statement, and consistency in positive cash flow through the cash flow statement. These insights will help you make smart investments, emulating Warren Buffett's approach. Mastering the language of business can be a game changer when it comes to investing, and Warren Buffett is no exception. Delving into the technical side of value investing, including determining a business's true value, requires proficiency in reading financial statements. Suppose you find a promising business to invest in, like Jane's Construction Company. The first thing you'll want to evaluate is their balance sheet, which reveals the company's net worth by calculating its equity, subtracting liabilities from assets. Keep an eye on the debt-to-equity ratio, as lower figures indicate better financial health. For instance, a 38% debt-to-equity ratio is more attractive than a 100% ratio. Next, analyze the income statement for the company's net profit. This is the income after taxes and expenses. Pay attention to return on equity, calculated by dividing net profit by shareholders' equity. A 52% return on equity exemplifies a strong investment, as anything over 15% is considered favorable. Lastly, review the cash flow statement to understand how the company utilizes its money. Look for strong, positive cash flow year after year, which demonstrates the company is financially stable and able to maintain daily operations, pay debts, and distribute dividends to shareholders. Temporary negative cash flow may occur due to major purchases or sales cycles, but a consistent positive cash flow history signals a healthy business. By understanding these three statements, you'll be able to make smarter investment decisions and utilize Warren Buffett's methods to build a successful portfolio. Mastering the net method. Enter the world of value investing with a crash course in the net method, an evaluation technique devised by Benjamin Graham, Warren Buffett's mentor. By understanding a company's net current asset value, NCAV, and the net current asset value per share, investors can identify undervalued stocks with a high margin of safety, setting the stage for potential investment opportunities. Diving into a company's financial records may seem daunting, but once you master the key to valuation, it will become second nature. When investing in stocks, the aim is to buy at a low price before they inevitably rise. The net method, conceived by Benjamin Graham and central to value investing, offers essential insights to achieve this goal. The concept behind net revolves around comparing two crucial numbers, the net current asset value, NCAV, and the net current asset value per share. NCAV, which is sometimes referred to as liquidation value, represents the remaining value after selling all assets and paying off debts. This leftover amount goes to shareholders. To illustrate this process, let's explore Jane's Construction Company. Jane's balance sheet reveals total current assets of $700,000 and total liabilities of $650,000. The difference, $50,000, is Jane's NCAV. Next, we need to determine the NCAV per share. This step requires tallying up all outstanding shares for the company, including those held by shareholders, employees, banks, and other stakeholders. Assuming Jane's company has 20,000 outstanding shares and an NCAV of $50,000, we find that the NCAV per share is $2.50. With this information, we can evaluate the company's current stock price. If shares are selling for less than $2.50, the company is undervalued, presenting a potential investment opportunity. The final aspect of the net method is establishing a margin of safety to ensure the best return on investment. Benjamin Graham recommended a 33.3% margin of safety, meaning the current stock price per share should be one-third less than the NCAV per share. If Jane's Construction Company's shares, for example, are selling for around $1.60, it would be an ideal stock to invest in. In summary, mastering the net method allows investors to identify undervalued stocks with a high margin of safety, providing a catalyst for promising investment opportunities. Using this technique and understanding its key components can give you a leg up in the world of value investing. Mastering portfolio management. Embrace the ultimate secret to investing like Warren Buffett by mastering your portfolio management skills. Understand and implement the 5 golden rules to wisely and responsibly manage your investments, allowing them to grow and prosper in the long term. You're on the cusp of discovering the final secret that separates investing legends like Warren Buffett from everyday investors: exceptional portfolio management. Recognizing that nobody can predict the future with absolute precision, crafting a diversified and well-structured investment portfolio is essential. This approach provides an opportunity for some investments to stumble or even fail without hampering the overall profitability of your investments. In line with Buffett's investment practices, diversification offers protection against ignorance. Adhering to 5 rules of portfolio management maximizes your chances of success. 1. First and foremost, focus on fund allocation. Determine how much money you plan to invest initially and how much you'll save for future endeavors. This decision requires reason and forethought. For example, Buffett stepped away from the investment scene in 1969, seeing that market values were inflated. Accordingly, his wealth was sheltered during the 1971 to 1974 market crash. 2. Secondly, avoid committing over 10% of your portfolio to any single stock. This simple guideline emphasizes the value of diversification, discouraging the reliance on a single investment for potential gains. 3. Thirdly, devote time to ranking the companies you're interested in investing. Rank them by your confidence level and allocate your funds accordingly. High-ranking companies deserve higher investments. This process also makes identifying undervalued opportunities a breeze. 4. Fourthly, schedule biannual check-ins to review your investment portfolio. Carefully examine the annual and quarterly financial statements of your holdings, making any necessary adjustments upon identifying potential issues. 5. Finally, don't rely solely on stock pricing to determine the value of a company. Great companies sometimes experience temporary market setbacks. Reframe your investment mindset by likening it to how you treat an employee. You wouldn't fire someone over a rough day or week. By adhering to these 5 time-tested rules, you'll lay a solid foundation for a wise and well-informed investment strategy. While they won't guarantee overnight wealth, they will undoubtedly set you on a sustainable path to financial success. Ultimately, it's up to you to employ these insights in pursuit of becoming a master portfolio manager.
As we wrap up this valuable dive into the world of investment strategies inspired by Warren Buffett, it's essential to reiterate some key takeaways. First, prioritize saving money and building good habits to lay the groundwork for investments that can yield tremendous returns. Acquire a deeper understanding of the stock market and the principles of value investing. Learn to identify businesses with strong economic moats and get acquainted with financial statements to determine a company's true worth. Master the art of portfolio management to help you diversify your investments and minimize risks. By implementing these timeless insights, you'll be equipped with the knowledge to make smarter investment decisions and create financial security in your life.